So welcome. Today we've got Jonathan Bayes, Prime's Chief Investment Officer, with us. Jonathan's going to talk to us a little bit about how he's seeing 2020 shape up. Markets are in a very interesting position, and it's going to be important from our clients' point of view to make the right decisions early on in the year. But Jonathan's going to talk to us about how to position portfolios and how to think about the year ahead. Welcome, Jonathan.
Thanks, Simon.
So Jonathan, let's start by talking a little bit around about the broader themes and your broader thoughts and what you think are going to be the key drivers into 2020.
Yep. So maybe taking a step back to go forward, it's worth understanding where things are. As we start 2020, the Aussie market here, 3 weeks into the year, is already up 7%. It was the best year in a decade for Aussie share market investors. We've got the easiest financial conditions on record in the United States at the moment. We've got money supply growth in China, the US, and Europe running well in advance of where it's been the last couple of years. And that's propelled markets to all-time highs. And there's a lot of optimism post the signing of the trade deal at the back end of last year that things are looking up as we go into 2020. So it's hard to be particularly negative in the here and now, but valuations are very high. We started the year with the Aussie and US share market at the highest level since the tech boom. Underlying earnings, particularly in Australia, have been very weak in the last 12 months, and it's probably unlikely that they'll improve in the coming 12 months. So momentum's good, but the stakes are very high, and we've got an election year in the United States and two very disparate policy platforms between some of the contenders in the Democrat Party and the President Trump as it stands now. And we've got a very accommodative US Federal Reserve, which has helped markets to fresh highs despite, as I say, middling economic growth in the US. So it's a tricky year to call, and so perhaps one of the big things that we're expecting is the volatility will increase in 2020. It's hard to call where the market might end up, but we do think there'll be a lot of trading opportunities through the course of the year because the volatility, I think, is going to increase. Yeah,
great insight. Thanks, John. So now let's talk a little bit about how our clients' portfolios are typically set up and just a little bit of reasoning as to why.
Yeah. So not a huge change to how we ended last year, but I guess the broad generalities would be the Australian equity portfolio is raising cash as the market pushes to new highs. Again, we think reporting season in Australia will be really tricky, so we're hoping to see some opportunities spring up to use the cash in the coming couple of months. Yeah. On the international side, we're increasing our exposure to value investors, emerging markets where we think value is better than in developed markets and where the economies are arguably turning a little bit as well, so China notably there. And then on the defensive side of portfolios, again, not much has changed in the last couple of years. We continue to think there's great risk reward in Australian property debt. Yep. Again, to generate 5 to 8% type returns on first mortgages in Australia with what we think is really attractive loan to value ratios is great income for investors looking to replace a lot of the income they lost with term deposit rates as low as they are.
Right, makes sense. So let's talk a little bit now about what you think are going to be the winners and the losers for the year, if you can be kind of that simple about it.
Yep. So across the asset classes, again, I keep coming back on the defensive side. Australian property debt just looks fantastic risk reward, as we've discussed before. So that's the first big tick in the box. I think emerging markets will have a better year. We're hoping for some outperformance there. The turn in the Chinese economy, I think, is currently underway. Manufacturing sentiments started to improve. Small business confidence has improved. Liquidity's improved. Yeah. And I think underpinning this confidence is that with the Chinese Communist Party 100-year anniversary in 2021, there'll be plenty of vested interest to ensure that it's a good market and a good economy leading into that. In terms of the assets that we think will struggle, regretfully, I think it'll be, again, the Australian market and the Australian economy. The bushfires, sadly, I think are going to take their toll on the economy in the early part of the year. Consumer confidence is already at a 4-year low. Job advertisement numbers are down almost 20% year on year. It's hard to be optimistic on the consumer economy here. And so I think the currency continues to fall. I think the Aussie market continues to underperform. And so like we've said every year for the last 5 years, we keep sort of saying, investors need to get more of their money offshore because the performance is likely to be a lot stronger.
Yeah, makes sense. So Jonathan, for a long time, Prime has talked about helping to protect our clients' assets and also build their wealth. With 2020 here, and what are the things that you're thinking about that we need to consider on the protection front and the growth, and just is there a particular thing that you think might have a more material influence over outcomes?
Yeah. So how we walk the walk on that. Sure. So maybe a good example of how we're looking at portfolios in the context of 2020 is around the presidential election in the United States, which we think will be, if not the key driver, one of the two key drivers of markets in 2020. And acknowledging that, whilst the odds are that President Trump gets in for a second term, we may well have a left-leaning Democrat nominee who holds policies in contrast to those which the US economy and country is run under as we speak. So Bernie Sanders, Elizabeth Warren both advocate for a doubling in minimum wage, increased regulation on the banks, on the drug companies, on social media platforms, Medicare for all, absolving student debt, a whole variety of factors which are very different to the world that we live in now. There's a very healthy consensus with low interest rates at the moment that the current consensus holds.
Yeah.
But I think if it looks like Sanders or Warren are leading the nominations through 2020, we're going to get a lot of volatility as the markets start to reprice the potential for a Democrat president in November. And so perhaps investors should be a little bit more reticent, holding a little bit more cash at these levels, which is something that we're doing because we think that it's highly likely that this will be a very volatile year because the spread of outcomes is so wide.
Yeah. So obviously with 2020 here and now, and having had what was a pretty interesting year in 2019, are there any things that you kind of sat back now with a bit of reflection and kind of go, well, that was unexpected, or that theme might continue into 2020? When you sit back, is there anything of that nature that is front of mind for you now?
Yeah, well, I think where we were taken by surprise, like many people, was the pivot from the US central bank with interest rate cuts. They cut rates about 3 times last year, but maybe more than that was effectively their money printing. We were expecting them to tighten what's been a decade of monetary stimulus in the US economy, take out about $800 billion from their balance sheets over the last 12-18 months. Instead, they pivoted, and we've had an injection of about $400 billion since September. And I think it actually makes it quite tricky for picking markets at the moment because the underlying fundamentals of the economy seem to matter far less than the cash stimulus into financial assets. And so we're very much at the behest of central bank policy at the moment, and that can clearly turn on a dime. So that was something that I think we missed, and probably a little bit more cautious than otherwise would have been. And it's a huge determinant for performance in 2020 and pretty hard to call.
Yeah. So let's now just talk a little bit about the next few months. There's a bit going on, but if you had to pick out, just a few key things for our clients to keep an eye on, what would they be?
Yep. So consistent with the big themes that we've got in the portfolio, which is Australia's economy struggling, emerging markets in China improving, and this US presidential election affecting everything.
Yep.
The key dates and catalysts that we're watching for portfolios would be locally the Fed reporting season, which will last, as I say, early Feb through to mid-late March, and that'll be tricky. I think we've already got a slew of profit warnings coming out as we speak now. The May federal budget, I think, will be a big feature for the government, ideally to roll out a fresh stimulus package and forego the budget surplus. I think we desperately need a new package to get the economy going. Okay. We will get interest rate cuts in the next couple of months, but I don't think they'll have much of an impact on the economy. Right. In China, the National People's Congress is in March, and we'll get all the key economic targets from them at that point. And then on the election, that's in November in the United States, but I think in the lead up, the key dates would be early February, where we get the Iowa and New Hampshire Democrat caucus, where we'll get to see really who's leading in the nomination for the Democrat candidacy, and then the Democrat National Congress, which is in early July. They will be the key feature points that we're watching for markets and expect to see volatility around those things.
Yeah, so a bit going on.
Yeah.
So thanks, John. That's been really helpful. I think that based on what I'm hearing from you now, there's quite a bit going to go on in the next couple of months, and so I guess the key message that I leave with our clients is to make sure that you're speaking to your advisor, make sure that your portfolio is set up the way that you desire, make sure that you understand the risks that might be inherent in that, but also the opportunities. There's no such thing as a silly question in terms of your portfolio. Yeah. So probably the key call to action that I've taken out of this is lots of activity, speak to your advisor, make sure you've got your asset allocation in the right position. It reflects the risks and the growth opportunities. And when there's something to do, we'll absolutely let you know and try to act on it as promptly as you can.
Yep, terrific.